Good morning, everybody, and welcome to our third webinar in our education sector webinar series here at BDO. My name is Kevin Frohbus, and I'm an IFRS advisory principal based in our Sydney office. Before I get into the webinar, just a comment: if you're experiencing any technical difficulties, please use the chat box. We've got some support on hand that can try and deal with that during the webinar. But ultimately, the webinar is being recorded, and so if you miss anything, or if you experience those difficulties, you will be able to receive the recording. It'll be emailed to you via a link. It's also available on our website on the education sector webinar series page at bdo.com.au. The other thing before I move on is questions. Please feel free to ask questions during the webinar in the chat box. I won't address them until the end of the webinar, and I'll try and address them as comprehensively as I can at the end, or I'll actually follow them up with you directly if I need more information. So let's get straight into it. Today's topic is IFRS 15 revenue from contracts with customers. The title of the webinar actually refers to the international standard IFRS 15, but for the remainder of the webinar, I'm actually going to refer to the Australian equivalent AASB 15, and that's because obviously the issues in this webinar are Australian specific, but obviously the reference to IFRS 15 makes reference to the international standard. Right, so moving into it, it's safe to say that this is one hot topic at the moment, mostly because this standard forms part of a suite of new standards that is going to be applicable to not-for-profits come 2019. You cannot look at the revenue standard AASB 15 without considering the income standard, income of not-for-profit entities. That's AASB 1058. And so this webinar will look at the two together. The suite of standards covers the financial instrument standard and the leases standard. Now, the financial instrument standard is effective in 2018. That's this year. That's not the topic of today's webinar, so I won't be referring to that. I will make a comment about the leases standard. The leases standard interacts quite well with the revenue and the income standard. In fact, I have seen examples where the revenue, the income, and the leases standard all apply at the same time, and that's because they're all driven by the contract, they're contract specific. But we will not be dealing with leases in this webinar either. We dealt with AASB 16 leases in our previous webinar in this series, and we will also be dealing with leases and peppercorn leases in particular in our September webinar in the same series. So you can head to our education sector webinar page and find last month's webinar on leases and register for the lease webinar in September for peppercorn leases. So let's get straight into it. And I think I always like to start these webinars with a poll. And I'm going to launch the poll. This is a state of readiness poll, really just to ask our attendees where you are in your state of readiness. Just checking with our technical gurus if it's come up on the screen. It has. All right, so the questions on this really is, how ready are you for these new standards? The options available to you are haven't started or don't think it'll have an impact. You've appointed an external advisor. You've evaluated one contract and you're still recovering from the trauma. You've assessed multiple scenarios and you've identified your transition needs. And you've actually, as a fifth option, designed changes to policies and systems and implemented or implementing the standards. So I'll leave that open for a while. A couple more seconds. We've had about 50% of the vote. I'd like to see us get maybe to 70% on that if we can. And then we'll actually close that and show the results. And the results are surprising in some ways, but also expected. I'm going to close the poll now so you can have a look at the results. I'm assuming the results have come up. Let's make sure I get the share button on that. All right, so there we go. The results are up, and I think it's 29% haven't started, which is similar to the statistics that we see in the IFRS advisory team. I'm glad to see that almost half of you have assessed multiple scenarios and I identify transition needs. Now, I have to make a comment at this point that the not-for-profit sector in particular is a lot more proactive, I think, on looking at these new standards than the for-profit sector. And that's interesting for a couple of reasons, mostly because the not-for-profit sector actually has an additional year to get ready for this, whereas the for-profit sector, they're in the mire already, and some of them haven't even started, as ASIC has noted with many of the listed companies. So well done on you for assessing those multiple scenarios and going forward. Hopefully, I can tailor today's session and address the topics a lot quicker, because half of you obviously will know a lot of this material. So I'll move through some of the theory rather quickly. The application issues I'm going to talk about, really, these are the ones that we are finding in the IFRS team in terms of trying to apply the standards. First of all, institutional neutral. And what I mean by that is it doesn't really matter what type of entity you are. Many of the issues are seemingly the same. Whether you're a TAFE, university, or school, many of the issues I'll discuss today actually apply across the board and actually into other sectors as well. Biggest issue we're running into in the adoption of these new standards is that it's a contract level assessment. Many clients respond in shock and horror when they realize that 600 contracts all need to be evaluated individually to determine what the impact is going to be. And so obviously the message we're trying to deliver to the industry is start early, but based on the poll I ran, it's good to see that half of you already done that. I had one national not-for-profit, not education sector, but they have federation level institution, and then there's state-based institutions. They were planning to early adopt. There's something like 950 contracts that needed to be evaluated, and they chose not to early adopt because once they realized just how much work was involved, they realized they actually had to get a team involved, and so they're actually going to adopt on the mandatory date in 2019, and that's just because of the pure volume of contracts that needed to be worked through to get there. So that's the key takeaway on an application issue, is contract level assessments means the more you have, the more assessments you need to do, and the more variation you can get. That leads us into the topics I'll deal with today and some of the issues that you run into when you look at these contract level assessments. Sufficiently specific performance obligations is the number one problem we're having with AASB 15, and that includes the education sector. That leads to judgment and policy application setting issues. What we mean by that is an enormous number of judgments need to be made, especially when you're applying this sufficiently specific performance obligation concept, and I'll get to that later on in the presentation. The entities that are having the most success with that are the ones that once they've gone through their contract level assessments and they've understood what the issues are in front of them, they start to set the way they will exercise their judgment within their accounting policy. So they set criteria about what it means to be sufficiently specific in their industry and in their entity, and then they start to apply each contract against that criteria or application that they've created. So the standard doesn't give you the answer, it really just gives you the guidance. You need to actually go and develop judgments and your application of those judgments in your own unique setting. And I think the message there, and I'll say it right from the start, is be brave in doing this one, especially in the education sector. There's a couple of examples I've got later on where you'll see the answer in the sector is a bit up in the air. Nobody really knows the answer, and the education sector is perhaps dithering on making a decision on where they are with what sufficiently specific performance obligations are or which standard applies. My advice is take the plunge, make the call, develop the criteria, and go and apply. It's the only way to do it. Be a leader, I guess, in some of these issues. The other ones on the issue: grants and contributions, research activities, non-refundable upfront fees, and transfers for building or acquiring non-financial assets. Those are really examples I'm going to do today. And those are all education-specific type examples, just to demonstrate the concept in the industry. All right, so I'll get through the basic concepts. High-level summary of the standard, AASB 15, revenue from contracts with customers. As the heading implies, it's a contract level assessment, as I've said. Yeah, you need to identify contracts with the customer. This is a for-profit standard developed at the international level. And so applying this concept in the not-for-profit and education space means that you need to figure out who your customers are and what those contracts look like. And it was a relatively new concept for a number of organizations to wrap their head around. But I think we're all over the hump. I mean, in a school scenario, it is obvious that the parent who enters into a contract to educate their client is your customer. The contract is the agreement to provide tuition, and the beneficiary in that scenario is the child or the student. So you can have a contract with a customer in the education not-for-profit sector quite easily. Same with grants. If you are the recipient of grants and those are your ordinary activities that you receive that money in the grant from, let's say, government, those can be contracts with customers because you are providing objective for the benefit of some type of beneficiary, a student or such, and government is providing the consideration in exchange for those services. So there's your contract with the customer, very easy to get there. The hump in applying the standard is step 2, identifying the separate performance obligations. Come back to that. This is where you get the sufficiently specific performance obligations. Determining the transaction price is relatively simple in the education sector. It's the amount you get, and then allocating the transaction price to those performance obligations, leading towards when do you recognize the revenue. Step 5 is also a bit of a killer step. Recognizing the revenue when performance the obligation is satisfied really is about when do you actually perform. And you'll see the link as I go through. The concept of sufficiently specific performance obligations is largely driven by whether you can actually apply step 5. That's what they're trying to get to. Knowing what the performance obligation is and whether it is sufficiently specific drives effectively knowing when you perform in step 5. If you don't know when you perform, you can't apply step 5, and that's when you drop out of AASB 15. AASB 1058 is then an Australian specific standard. It was developed really to replace the contribution standard, AASB 1004, which is the current standard. And it's got to capture these arrangements where somebody gives you money or an asset to enable you to further your objectives as an education institution, and where they're giving you that asset or that cash for less than the fair value of the consideration given. And really we're looking at donations, contributions, and really those in-kind type transactions where you get the asset to, let's say, further your objectives, and you don't really have to provide anything back to the customer, or there's no promise of a transfer of good or service. The income for not-for-profit standards is no longer really focused on the income. It's actually a balance sheet focus. So the way it works is you start with debiting the assets that you've received, whether that be a cash or a leased asset or property, plant, and equipment. The credit side is then applying a relevant accounting standard. So do you have revenue, or is there a lease liability, or is there a financial instrument? And really, if there is an excess left of A over B, that's the income that goes to profit or loss. So it's not really about the income being the thing you got. It's actually about the residual that's left after you've recorded all your assets and liabilities. The trick, of course, is the interaction between these standards. Now, the interaction between them is driven by this screen, and this is the most important assessment you'll make. This is a high-level summary of the contract level assessment you'll do. First question with any contract is, does the transaction occur in a contract with a customer? And the concepts that are important here is, one, you have a customer, so you've identified the party that you earn your consideration from your ordinary activities. And in my previous example, in the school scenario, that's the parent who has entered into a contract for you to provide tuition to their child or to the student. The benchmark in this question is, are there enforceable rights and obligations? The contract must be enforceable. Once you get past that question, then you need to really answer, do I have sufficiently specific performance obligations? So you can see here that this is a diagram of step 1 and 2 of the AASB 15 standard, the revenue standard. Are those performance obligations sufficiently specific? And there's a couple of criteria there. Most importantly, you need to promise a good or service to transfer to the customer or to the beneficiary. And then, like I said before, you need to be able to sufficiently specifically identify when you're going to actually perform. So the performance obligation and the ability to identify when it's performed is what you're trying to determine in this step. If you can't determine that, you drop out of 15 and then you consider whether 1058 applies. Otherwise, you are in 15 and you then apply the revenue standard. Interestingly, here in the not-for-profit space, there is a specific appendix that has been developed in Australia. It's Appendix F that goes with the revenue standard. It's got all the guidance in it that you need, and it's actually an enormous number of examples in there that deal with universities and research activities. It's an integral part of the standard, so you really should look at that appendix when you're looking to apply 15. If you can't find it, a Google search AASB 2016-8 because it actually was a separate issue, but it ultimately is an appendix to the revenue standard specifically for the not-for-profit sector. Right, so that's the boring basic concepts. So let's just get into the gritty stuff, and we'll look at grants and contributions. And I'm going to start with a basic example. Take a literacy program, bit of education thrown in there, but this could really be for any type of grant received by any organization or institution. An entity receives a grant from government to run a literacy program for 3 years from 1 July 2019, and the question is, does AASB 15 apply? So heading back to our all-important decision tree, does the transaction occur in a contract with a customer? So the first question you have to ask yourself is, does this create enforceable rights and obligations? And that will then follow to, does the contract include sufficiently specific performance obligations in order to apply the standard? Now, step 1, enforceable rights and obligations. The types of things you're looking for here are really, can the customer enforce the contract? Examples on the screen is you've got to pay back the cash or give something back in kind if you don't perform, or they have a right, and we're talking legal right here, to claim damages or to enforce the obligation. They can take an interest in an asset if you've purchased or constructed the asset with money or contribution given if you don't perform. Really, there's a number of scenarios there that can be applied. In the real world, what you're really looking for here is a contract that exists in law. I think the more important aspects to look at are the ones that I put on the screen. What are the consequences of failing to perform? If you don't perform in accordance with the contract, there's no consequences. And really, if the customer doesn't have the capacity to enforce the contract, you probably don't have a contract with a customer. The ones we often look to are, is there a return of the consideration, or is there a penalty of some way that actually is so severe or sufficiently severe to compel the entity to perform? But I think in the education sector, many of these agreements are legally enforceable. Many of them are in writing, agreed between the parties, enforceable in law. The sector is sophisticated enough to not really have too many of these things done informally. So I think in many of the scenarios from schools and universities, when it comes to grants, contributions, providing tuition, they are pretty well formulated, and so you generally get past this question relatively easy. The next question then, of course, is there sufficiently specific performance obligations? The guidance in the standard is relatively simple. It doesn't take up more than a few paragraphs. And what they say here is you need to have promised to transfer a good or service. So you actually need to identify what is it that you've promised to do, and is that a good or service? And then the idea is that it must be sufficiently specific to be able to determine when the obligation is satisfied. In other words, you must be able to apply the 5-step model all the way to step 5. And yeah, you need to consider things like the nature or type of good, cost of value of the good or service, the quantity, the period. This is where the judgment and policy application setting comes in. Those educational sectors, institutions that we've worked with who are having the most success on this criteria are the ones that are having the debates with the professional advisors, having the debates internally, having the debates with the customers, and then they are setting the criteria that they believe that they should apply in their organization, against which they evaluate each contract and say, well, this contract satisfies those criteria and therefore we have sufficiently specific performance obligations. It's really a systems determination. Do your systems and processes internally and your internal controls, can they be adapted in order to apply the standard all the way to the fifth step, step 1, 2, 3, 4, and 5, based on what it is you do, whether you are doing tuitions or research, and those types of things. So heading back to example 1, the literacy program example, polling question for you. Based on what we've done, the entity receives a grant from government to run a literacy program for a 3-year period. Does AASB 15 apply? Yes or no? A straight binary answer. So I'll launch the poll and let's see what you come up with. All right, and I don't think I might have to wait very long. Everybody's hopped straight into an answer, straight off the bat. We have about 60% of the vote already up on the screen. I'll just wait until we maybe hit 70 or 75% of that. Does AASB 15 apply? All right, let's close the poll and share the results. And I think there's a pretty clear winner there. 87% of you say yes. Of course, I'm going to disagree completely with the 87% who have voted and say probably not. And I'll tell you why. I don't necessarily think the answer is sufficiently specific, because although we have a 3-year period, I have a number of questions. Who is this going to be provided to? Who are the students that are going to benefit? And can you determine when it is you are going to perform? I think when we put a 3-year period onto something, we often default. Sorry, do I need to hide my poll? I've got to hide the poll. Getting past the technology bug. Thank you. I think when you get into these types of debates internally, a 3-year period at least establishes a time period. Now, the AASB did intend a broad interpretation of what they meant by sufficiently specific, but straight lining the grant over 3 years doesn't necessarily represent when you are performing. It's an easy cop-out just because there's a 3-year period. So it is a little bit of an interpretation here. I don't necessarily disagree with the 87% who said yes, but I think that if you're applying the standard, you really should have a further debate with yourself about, well, what is it that I'm actually doing? Can I actually identify when I'm doing it, or am I just defaulting to 3 years because I have a 3-year period in it? I'll take you through some of the concepts that I'm trying to explain here. Recognizing revenue and performance obligation is satisfied in step 5 actually does require you to come up with an input method or an output method to measure progress towards satisfying the objective. Recognizing of a straight line is really just saying, well, I think this is when I'm doing it, and I'm actually doing it evenly over that period. And that may be true. If you are running a literacy program where you are performing equally each month over the 3-year periods, absolutely, you probably have a sufficiently specific performance obligation. But if that's not the case, then you probably don't have sufficiently specific performance obligations. Going back to the example, I put 2 more scenarios on this slide where I said, well, if I consider these examples, these scenarios, if I say to you the literacy program was tailored to suit the needs of students and the students must progress through 10 levels of testing, is that sufficiently specific? Well, it could be, but once again, we've got holes in the argument. Which students have to progress through 10 levels of testing? And do those students actually participate in the literacy program over the 3 years? Or maybe they only participated in the first year. Once again, it's trying to decide whether you can actually represent or measure your progress towards actually satisfying the objective. The last bullet point on that slide was If I take the same example where I've got students that must progress through 10 levels of testing, but the test results based on the students must be reported to government through an acquittal process. Here we have an example that is obviously clear that the students are identifiable, and the acquittal process actually allows us to measure or actually identify when it is we are performing. And we could actually then very clearly apply the 5-step model. So the last bullet point on the screen is an absolute yes. You can apply the literacy program on, over a 5-step model, and AASB 15 will apply. But just on the face of a 3-year period, be very careful of concluding that that is applicable under 15, because a straight line method over 3 years only really is applicable if you are confident you are performing equally over the months in those 3 years. Hope I haven't caused too much controversy with my comment to that one. Let's do another one. An alumnus transfers $2 million to an entity as an endowment. The endowment must be returned if not used for its purpose. Consider these scenarios. Now, the reason why I said the endowment must be returned if not used for its purpose, I'm establishing an enforceable contract, enforceable rights and obligations. If it's not used for what it's intended, it's got to go back. That's first question. Second question is, do we have sufficiently specific performance obligations? Now, there's 2 scenarios on the screen. The first one is that you must provide 1 student with free accommodation at the institution's residence, so whether this be a university or school. And the second one is the cash must be preserved and a cash scholarship must be provided to students. I think there's a couple of words missing off that slide. But the two scenarios is you've got to use the 2 million either to provide free accommodation at the institution residence, and the second scenario is you must preserve the $2 million and the interest will then be used for cash scholarships to students. Thinking about those two, the questions about sufficiently specific performance obligations and whether the standard applies, I'm going to open up a poll. The poll is yes, both scenarios apply to AASB 15, or only one of them do, or neither apply to AASB 15. Let's see what you can come up with on this one. I'll open the poll. This will be our final poll. All right. Couple of you changing your minds as you go. There is definitely a weighting towards one answer, although maybe I see a strong leaning towards at least one. All right, we've got 65% of you have voted. Hasn't moved for a couple of seconds, so I'll close the poll and I'll share the results. So sharing the results on the screen, yes, 65% of you believe at least one of those is a sufficiently specific performance obligation under a revenue contract. Of course, I'm going to be controversial again. That's the whole point of this. And once again, there is no right answer to this. This is actually just a theoretical discussion. You don't have all the information. I've only given you snippets. The idea of this is you would do a full contract assessment and understand all the terms of your contracts. But I will tell you what I think, or what I intended when I put this together. So the first one is provide 1 student with free accommodation at the institute's residence. Well, we've established we've got an enforceable contract. The next question, is it sufficiently specific? We do have a promised transfer of goods. That's the accommodation. The question you've got to ask yourself here is, can you measure progress towards that? Now, very often it would be something like each year 1 student gets free accommodation. In that case, you'd have a sufficiently specific performance obligation. But if the time period is unknown, as it was in this example, provide 1 student with free accommodation for how long? If you don't know the for how long, it's probably not possible to apply the when. So that one might fail the test depending on the when, depending on the time. And I didn't give you time in that scenario. The second one is the cash must be preserved, but the interest will provide cash scholarships. This is a tricky one because it actually isn't about the when, it's actually about what the good or service is. And in this scenario, there actually isn't a good or service. You've actually promised a cash scholarship, which actually means you've got a financial instrument lurking. you don't actually have a promised good or service. So that one actually fails off the bat, and it is an example straight out of the Appendix F that I referred to earlier. If I had answered this question, I would have gone no to both scenarios. I think there were about 25% of you who went for that answer, because I think the first one fails on the time. It doesn't say for how long this accommodation is going to be provided. And the second one fails because there isn't a good or service there. It's actually a cash scholarship being a financial instrument. So I would drop into AASB 1058 in this scenario. I would go debit asset, the 2 million cash received, and I would go credit, well, for the financial instrument one, you're going to go credit 2 million because that's a cash scholarship. A financial instrument arrives. The cash scholarship one probably doesn't give rise to income because there will be no excess in that scenario. The school accommodation one will be debit asset 2 million, credit nothing. There will be income under there of 2 million because there isn't a promised revenue transaction because it wasn't sufficiently specific. But once again, coming back to it, it's very dependent on the example. And I'll go back in particular the student accommodation one. Normally those contracts are quite specific about what the time period was. I just left that out to be a bit tricksy in today's webinar. All right, so once again, hopefully I haven't caused too much controversy with those. I'll now look to research activities. I've chosen not to include in the webinar detailed example of research activities, but this is proving dramatic for a number of universities. This is where you receive grants to perform research activities, and the contracts are wildly different from institution to institution, and even from some departments to some departments. The AASB chose to give an extensive array of examples to try and develop concepts that you can use to apply here, and that is contained in Appendix F of AASB 15. Some of the themes that emerge out of that are whether there's a transfer of a license or IP arising from the research, and also whether the research is made available publicly. The trick here is that research activities themselves are not performance obligations. They are really just activities. But when the research activity transfers a good or service, such as the transfer of a license to use the output or intellectual property arising from the research, such as there's data that comes from the research that gets public on a public website, which any researcher can use, or as if it's made available publicly. For example, you've got to publish, the criteria is you must publish in one journal. Those then establish a transfer of a good or service, and then depending on whether you can measure progress towards it, when, you would then fall into 15. Otherwise, you would fall out of 15. So research activities, once again, contract specific. This one I would suggest that if the universities, most of them have actually already started and are developing criteria around this, they're using the Appendix F. I'd just like to say that the Appendix F is guidance. It is an integral part of the standards, but it's not conclusive. It's there to demonstrate the application of judgment, but you need to go and set your own policies on how you interpret that in the context of what am I performing, what am I transferring, and is it sufficiently specific to measure progress towards achieving that transfer of that good or service. All right, non-refundable upfront fees. I can guarantee you that half of you on the webinar today are waiting for this one because it is the most controversial topic of all that we've faced. Our IFRS advisory team has spent hours debating this one, and I know that there is some differences of opinion out in the industry, and it really comes down to the non-refundable upfront fees that schools charge parents, enrollment fees, and application fees. And the only way to do this is by way of an example. So in this one is the student is offered a place at a school. On acceptance of the offer, the parent pays a non-refundable enrollment fee equivalent to one term's tuition fee. It cannot be offset against future tuition. Does AASB 15 apply? I'm not going to run a poll here because I think it's just going to be all over the place. Before I move on this one, I have used the word enrollment fee here. That is not always the term that is used in the contracts, but that's the one that is mostly used amongst the private schools. And this is not the fee to consider an application or to be put onto a wait list. This is the actual fee that's paid when an offer is made. So we are offering your child a place at a school, and normally the way it's written is it'll say something along the lines of, if you accept this offer, acceptance is conditional on you paying the enrollment fee. So it's that scenario. Some of these things can hang around for years because the offer can be made 5, 6, 7 years before the child attends the school, and you've got this non-refundable upfront fee that's paid, this enrollment fee. The current practice is to recognize that immediately. The big debate in the industry is, does this fall into AASB 15? Because if it does, the enrollment fee needs to be deferred because it's not actually a fee for income on receipt. The enrollment fee is part of the consideration to provide tuition. So looking at our little decision tree again, does the transaction occur in a contract with a customer? And the answer is yes. Now, before you jump to sufficiently specific performance obligations, you really need to think carefully about whether the first question is met. Very clearly in the example I've given you, there's been an offer and acceptance, and that is a legal determination of whether a contract is created, and it is. An offer and acceptance, if you accept and you pay the fee, a contract exists. So enforceable rights and obligations exist. The next thing is whether we have sufficiently specific performance obligations. The answer is yes, because you have agreed to provide tuition for the student, and I can guarantee you that the period will be clear, over the term or the year or even over the entire life that the child will attend the school. So very clearly, you're going to drop into 15. Applying 15 says, well, when do you recognize the enrollment fee? And then you apply the 5-step model. And the 5-step model is, we've identified the contract, we've identified the performance obligation. The performance obligation is tuition, and then determine the transaction price. And the transaction price is then the enrollment fee plus the tuition fees together into step 3. Allocating that then to the performance obligations in step 4 means that the enrollment fee must be recognized when the tuition is provided in step 5. And that's why it's really important to apply each of these steps individually, because what you'll see is that the enrollment fee is obviously related to the tuition, at least in the view of AASB 15. I know that the schools don't necessarily see it this way. They see the non-refundable part of it being, well, I'm never going to refund this, so therefore surely I can take it into income. It's not an income transaction, it's a revenue transaction, and the promise you've made to your parents is to provide tuition, and the standard is very clear that enrollment fees or these types of non-refundable upfront fees are part of the consideration to provide the tuition and would be deferred until the tuition is provided. I don't think there's anybody that disagrees with this in the industry. I hear some murmurings in the industry about disagreements, and I know some firms are kind of debating this still. I haven't yet seen a documented policy that convinces me or really anybody else, but this is the answer. Now, I haven't looked at the chat box, but I'm sure it's going off. No, not? All right, maybe we're all happy with that one, but it is the number one question I get. The application fee, I don't have a slide on that, but I will talk to it. The application fee is a little bit more up in the air. This is the one where you receive a fee when the application is received from the parent. So an application is submitted, they go into a wait list, and then that leads to an assessment process of some sort, and ultimately at some point in the future the child is either offered a place or not. This is a bit more controversial, and I know that the sector is looking at the AASB for guidance on this one, but you need to apply the principles to this one. First question is, do you have a contract with a customer? So the question you've got to ask yourself there is, how is this application fee and this process for assessing an application structured? Does it create a contract with a customer? Am I entering into a contract with those parties for the provision of my ordinary services of tuition? And there's some general debate about that. because schools are not in the business of providing assessments of applications, but it is true that those applications lead to students which ultimately will be provided tuition. So there's a feeling that this does fall into step one. The next question is, what is the separate performance obligation? And there's an enormous debate out there. Is it maintaining a wait list? Or is it the assessment process that ultimately leads to an offer or acceptance? The transaction price is obviously the fee, but it's a little bit up in the air in this one. I guess in terms of my own opinion is that on this one, it's probably not linked to the tuition. It is linked to an assessment process of some sort that leads to an offer. The idea behind this is probably is going to fall out of 15 at some point because it's not the ordinary activities that we do. This is where some of the debate falls out. And I think the big debate is really just, is it recognized over the time of the wait list, or is it recognized at the time the offer is made? There are some who still believe that you recognize it immediately. That's up for debate. And like I said, the AASB has been asked for guidance on this one, or we're looking to the AASB. I'm not promising that guidance is coming from the AASB. I'm just saying that this has been elevated up, and they are aware that this question on application fees is a little bit up in the air. But I certainly personally believe it doesn't ultimately form part of the revenue contract once the offer has been made, but it obviously is dependent on how it's structured and how a contract in law comes into effect. So this one I'm going to leave it open, and I'm going to say it's a wait and see in the industry. All right. I actually covered the slide already. This just finalizes the example on enrollment about linking the enrollment fee to performance obligations. Okay, hopping back to the webinar, last one to talk about is transfers to acquire or build a non-financial asset. This is really where you are receiving money from a parent or really a grant perhaps to build a new building or into a building fund for the schools. And the promise in that scenario is to construct or acquire that asset. Is actually dealt with in AASB 1058. There's specific guidance in AASB 1058 on this. I guess the first question you got to look at is, have you promised to provide a building or build a building or construct an asset or acquire an asset that is a contract with a customer? So you still need to move through that process first. And we'll take a grant. I mean, let's take a university that receives a massive endowment to build a new science center. That scenario would first be considered under 15. Do you have an enforceable contract with enforceable rights and obligations? And is the promise sufficiently specific to create a contract with the customer? Generally, the answer is it isn't a contract with the customer, and the reason why is the building doesn't go to anybody else. So the transfer of good or service doesn't happen. What happens is the university gets the building. It doesn't transfer that on to someone else. So if the money comes in and the asset is constructed and the entity will control it, like the university controls it, it's not a contract with a customer because the asset doesn't get built for someone else. It gets built for the university. There are three conditions that are dealt with in AASB 1058. The entity must use the transfer, in other words, the endowment or the money received, to actually acquire or improve an asset. It doesn't transfer it to another party, so that's why it falls out of the revenue standard. And there is an enforceable agreement that leads to it. In those conditions, those three conditions, the specific requirements in 1058 will apply. I think it's paragraphs 15 to 17 of AASB 1058. And the answer is, what you do is you recognize the transfer that you've received as a liability or as an obligation, and you release that as you build the asset or as you acquire the asset. So there's a bit of matching in the balance sheet that goes on. Once again, as with everything in these standards, it's contract specific. So you need to look at the terms and conditions of the contract and the parties involved. I do know that there's been some debate and there are a number of questions in the school scenario where the schools have agreements to to take like enrollment fees or payments by the parents at the start and transfer them into building funds, and whether that actually falls into this section. And it's very specific on the terms of the contract. So one example is if you are a parent and you've accepted an offer for your school or your child to be enrolled in a school, and the agreement says that the enrollment fee you pay at the beginning will be transferred into the building fund to build a new building at the school. The question is whether that actually gets accounted for under this criteria, and the answer is it depends. It depends mostly on who the contract is with. A contract between a parent and a school for tuition doesn't necessarily establish a contract between the parent and the building fund. So you need to look at that first. It doesn't necessarily change the answer on the revenue transaction. On the other hand, as I said, a contract between a university where they get an endowment that is specifically to build a new science center, and that's the enforcement that the endowment can trigger. Well, that is clearly meeting the three criteria. Yeah, it's clearly a transaction for building a specific asset which the university will control, and then this criteria will apply. So it is contract specific. Make sure you understand the parties involved in the relationship. Very often the arrangement between the school and the building fund, for example, is actually between the school and the building fund, not between the parent and the building funds. So you just need to look at those type of arrangements. Now, I have rambled on, as I often do, for a fairly decent amount of time. At this point, I will open up the question box and see if there's anything in there. Is there anything in there that we can have a look at? I actually can't see any questions sitting in there. Okay. Just give me a moment while I sort the technology out. And we have a question from David Barker. And David, nice to see you, nice to chat you again. And the comment about the admission fee being accessing the school in the first place. Yeah, look, I mean, I've heard this argument, and I certainly don't disagree with the argument. I'd like to see it put down into writing with referencing. And I think we'll take that one offline. I know that one of our partners is working with you on that one. There isn't actually any other questions in there. So I think at that point, if we don't have any other questions, good luck out there, and we'll see you in 2019 on the application date. If you do have any questions or you need assistance, there are people in our IFRS advisory team that you can contact. I'm based in Sydney. We've got a letter in Melbourne, Wayne in Perth, and Clark in Brisbane as the key contacts. We'll take those queries up. Thank you very much, and hope you enjoyed the webinar.